Welcome, everybody. Welcome to Accounting is Fun. This video is on accounting for corporations, how corporations account for selling shares of stock to raise money for capital for their business. So we're going to focus on some characteristics of a corporation, what makes a corporation so unique from a partnership or a sole proprietor. So let's look at that. I'm going to share my screen with you all, and it's right here. Let's take a look at it. Well, before we do, we're going to focus on the accounting equation. Remember, the accounting equation is assets equals liabilities plus equity. So we're focusing on the equity side of our equation. And under the equity umbrella, if you will, equity is really broken up into two parts: the paid-in capital, which we're going to be seeing tonight in this video, on how shares of stock are sold by the corporation and sometimes bought back, but we'll see that. So the paid-in capital is all the amount of stock sold by the company, right, to purchase interest in the corporation. And the retained earnings, the other section under equity, is where all your net income is retained, and it's paid out in form of dividends. When the corporations want to reward their stockholders with some money, they will pay it out of retained earnings in the form of dividends. Okay, so these are the two main sections under equity: paid-in capital and retained earnings. So for corporations, there's some new vocabulary, as I mentioned in many videos, that accountants have a language all their own. So we're going to look at some of these terms and regarding corporations. One, every corporation has a bylaw. In the corporate bylaws, it issues the classes of stock that they'll be selling: common stock, preferred stock, two main classes of stock. They'll also state how many shares they're authorized to sell. And then another characteristic of a corporation, it has indefinite life. So if you bought, say, 10 shares of IBM, and you'd be an owner of IBM. You can go and press all your friends and tell them, hey, I own IBM. Okay, what does that mean? Does that mean you can bust into the headquarters of IBM and say, listen, I own IBM. I want to make some changes, and I want to make them now. What's going to happen? The front person at the front desk is going to call security. We got some nutcase in the front lobby. Anyway, so being an owner of a corporation doesn't necessarily mean you're going to be managing the company. That means you've invested some money into the company, and if you sell your shares of stock to somebody else, the company doesn't go under. It has indefinite life. The only time it will go out of business is when it actually liquidates and goes out of business. Just because you sell your shares of stock to somebody else, it doesn't mean that the corporation is going under. Unlike a sole proprietor, if you get out of the business, you're out of the business. It stops. But corporation is different, right? You have shares of stock, you're an owner, but again, there are many owners in a corporation. And corporation owners have limited liability. So if you invested say $10,000 of stock in a company, you can only lose the $10,000 of stock, what you invested in. Okay? And then the ease of acquiring capital. When corporations have their initial public offering, they have their shares out there selling to all their potential buyers. There's many people have access to the stock market to buy the corporation stock. Okay? They can also sell it anytime they want as well. But it's very, very easy to acquire shares of stock. You can buy it for the most part. The stock we see on the ticker symbols, when you look at like MSNBC or Bloomberg, whatever, on the bottom of the screen, you see little ticker symbols going across. These are typically the common stock symbols, or ETF, which is an exchange traded fund, which is a combination of many companies into a fund. It's like a mutual fund. And then preferred stock, the preferred stock is more for your institutional investors who want to buy the stock, and it has preferential treatment in terms of its dividends. And when the company goes under and liquidates, they're higher in the pecking order in terms of getting their money back, whereas corporate common shareholders are at the bottom of the pecking order. Preferred shareholders are slightly above. You have your secure lenders, unsecured lenders. They're going to get their money long before the preferred, and then common shareholders are lucky to get anything when the company liquidates. All right, so these are some characteristics of a corporation. All right. So, but let's take a look now when companies sell stock. Okay, so they're out there selling stock for the very first time. As I mentioned, there's two classes of stock, common stock and preferred stock. Let's go back to those two for a minute. Common stock are your voting shares, your common shares. Again, those are the shares of stock that you and I would buy or in your either a brokerage account or what have you. Okay, the preferred stock, again, is more for the institutional type investors. Although you could buy a preferred ETF, which is a basket of preferred stocks, it'd be easy to buy one of those. Okay, so the common shareholders are your voting shares. If you have a common shareholder, if you're a common shareholder, if you have common stock, you can vote your shares and make your voice known. Okay, you can't storm into the front lobby in my previous example and demand to make changes. You get arrested. Anyway, you can vote your shares in the proxy. And then preferred shareholders, they have preferential treatment in terms of dividends. They get their dividends before common shareholders get any dividends each year. And we'll talk more about dividends in a bit. Okay? And then preferred shareholders, again, as I mentioned before, they are higher in the pecking order in terms of being able to recoup some of their investment if the company goes under. Okay, so let's take a look at a company who sells stock. Well, before we do, we got to talk about par value or stated value. Most corporations have a par value on their stock. A par value is just an arbitrary amount assigned to a stock. It's for record-keeping purposes for the most part. For instance, I mentioned IBM. IBM sells for over $100 a share, but its par value is 20 cents. Okay, par value means nothing other than for record-keeping. It has no semblance on what is trading on the open market. Same with like Facebook. Facebook par value was less than a penny. Okay, so it's crazy valuation. It means nothing. Okay, it's just, again, for record keeping only, because stock goes on the books at par value and comes off the books at par value. So if they sell a stock above par value, any excess goes into a paid-in capital and excess of par account. So let's take a look at an example here. XYZ sells 1,000 shares of $1 par value common stock for $10 per share. Okay, so what's coming into the corporation? Cash, right? They sold 1,000 shares at $10 a piece, so $10,000 is coming in. So we debit cash for what's coming in, $10,000 of cash, and we credit common stock for $1,000. That is an equity account. It's ownership in the business, but it goes on the books at par value. 1,000 shares times $1 par value is $1,000. The excess, the $9 excess between the 10 and the 1, the $9 times 9,000 shares, $9,000 gets credited to this paid-in capital in excess of par. Both of these are equity accounts. They both fall under the paid-in capital umbrella of equity, right? So you have your common stock and your paid-in capital in excess of par will be falling under this category here, okay? So this is how you record a sale of stock. We're going to go through an example of that. Actually, we're going to go through that pretty soon, okay? And then before we go into that example, I just want to call your attention to what the bigger picture, what the stockholders' equity, so going back to this example here, under the equity section, you have paid-in capital, you have retained earnings, you have something called treasury stock as well, which is, it's not in this diagram, but I'm going to show you what it will look like in the statement of stockholders' equity. So what does this look like on the balance sheet? As you know, the balance sheet is just the accounting equation broken out between your assets, on one side of the balance sheet, your liabilities and equity on the other side of the balance sheet. So what does the balance sheet look like for equity? Let's take a look here in this little schedule I have here. Under the stockholders' equity, on the balance sheet, how would it be reported? You would see paid-in capital, again, the paid-in capital section, okay, which is made up of, in this case, preferred stock. It shows the par value, how many shares are authorized, and how many shares are issued and outstanding. Let's talk about some of these. We'll talk about that when we get to the common stock particularly. Then common stock, $1 par value, there's 500,000 shares authorized. They sold 1,500 shares, but there's only 1,300 shares outstanding. So let's talk about authorized, issued, and outstanding. As I mentioned before, in the bylaws, corporations are authorized to issue X amount of shares. Let's focus on the common stock. They're authorized to issue 500,000 shares of common stock. If they want to issue more, they have to get a vote of all the shareholders. And typically shareholders, for the most part, don't like additional offerings because it usually dilutes the shares that they have. Not all the time, but do they balk at it if the company is growing? But oftentimes they'll say, "Oh no, more shares. That means my stock is going to be worth less because now there's more shares. It's a law of supply and demand. The more shares out there, it liquidates. It dilutes your the value of your shares. Not all the time, but oftentimes. Okay? So common stock, $1 par value, 500,000 shares authorized. There's 1,500 shares issued, and you can see under the common stock on the balance sheet 1,500 because 1,500 times $1 is 1,500. Okay, and then 1,300 shares outstanding. Why is outstanding different than issued? So you have authorized 500,000. We sold 1,500, but we only have 1,300 shares outstanding. Outstanding means in the public's hands. That means the corporation bought back 200 shares. We're going to talk about buybacks, stock buybacks in a bit. When corporations buy back stock, it shows up as treasury stock. So here they bought back the 200 shares at looks like $10 a share. So it's sitting out here on the balance sheet as a negative to the stockholders' equity. Treasury stock, when corporations buy back their own stock, it's a contra equity account. Contra means opposite balance. So treasury stock will have a debit balance, which will be reducing your stockholders' equity. So here, so you see this paid-in capital of $100,000 made up of all these stock sales plus paid-in capital in excess of par and preferred and uncommon. Then you retain earnings. This is all the net income retained in the business that have not been paid out in form of dividends. You have a subtotal between your paid-in capital and retained earnings. Subtracted from the subtotal will be your contra equity account here, treasury stock. And so your net total stockholders' equity is $578,000 in this example. Okay, so we're going to go through examples of issuing treasury, issuing stock. Then we're going to go through an example of dividends, and then we'll go through an example of how to account for treasury stock. Okay, so let's go look at issuing stock. Okay, first example. So Orr Corporation had the following stock transactions for the month of June. For each transaction, record in the journal provided. Okay, so on June 1st, corporation issued 5,000 shares of preferred stock, $20 par value for cash of $100,000. Okay, so what's coming into the corporation? Cash. Cash is coming in. 5,000 shares at $20 par value, they get $100,000 cash. So we're going to debit cash. What's coming in? $100,000. That's what came in. And preferred stock goes on the books at its par value. In this case, it's 5,000 shares times $20 par value or 100,000. So the shares sold at par value. There's no excess. There's no paid-in capital in excess of par because the preferred shares sold at par value. Okay. On June 10th, they issued 12,000 shares of preferred stock now for $275,000. So again, how much cash is coming in? $275,000. So we'll debit $275,000 for cash coming in. Preferred stock is going on the books at par value. So we find a preferred stock account. And we sold 12,000 shares at a par value of $20. That's $240,000. So there's an excess of $35,000 here. That $35,000 is going to go into the paid-in capital in excess of par. Okay, so we're going to find that account, paid-in capital in excess of par, and there it is. Okay, again, it's an equity account. It's part of the equity umbrella, okay, under the paid-in capital section. Okay, so as I mentioned in the previous videos, every entry, your debits have to equal your credits. Left must always equal right, always. Okay, so now let's look at June 12th. We issued 100,000 shares of common stock, $5 par value for $660,000. Cash coming in, $660,000. Whoops, $660,000. And then common stock is going on the books at par value. so par value is $5. So 100,000 shares times $5 is $500,000. So we have excess of 160,000 above par value is going to go into the paid-in capital in excess of par account. Okay. Oops. Paid-in capital in excess of par. Gotta grab the right one. Here we go. Okay. Now, June 26th, we issued 200,000 shares of common stock, $5 par value, in exchange for land. The stock was trading in the open market at $7 per share. Now, here's an interesting thing. We're not getting cash, we're getting another asset. Whenever you have a transaction that involves selling stock for another asset, the value of this transaction will go on the books at what is the most readily determinable fair market value. Obviously, stock trading on the open market, common stock is trading in the open market every day. You can't get much more fair market value than that. You get up to the minute nanosecond valuations. Okay, as opposed to exchange for land, you want the land valuation, you have to get an appraiser and all that good stuff. So in this case, the common stock trading on the open market clearly is going to be the indicator of the value of this transaction. So the land, the asset that you're not getting cash in this case, you're getting land, will go on the books at the 200,000 shares times the fair market value at the time of the sale as of $7 per share. So $1.4 million will go on the books for the land. Okay. And then what's going on the books? Well, we gave up common stock to get the land. So common stock is going on the books for the shareholders who sold the land to us. And again, it's 200,000 shares at a par value of $5. That's $1 million. So we have excess of par on this transaction, $400,000 paid in capital in excess of par, $400,000. Okay. Now let's look at June 30th. We issued 5,000 shares of preferred stock, $20 par value, in exchange for a machine. The machine was valued at $110,000. So here, the machine has a fair market value of $110,000. The preferred stock, it doesn't say what the fair market value is. It may not be a market readily available for this preferred stock. So what's going to drive this transaction will be the fair market value of the machine. So we'll debit the machine for $110,000, the fair market value. Preferred stock will go on the books at par value. Let's find it, preferred stock. And that's 5,000 shares at $20 a share, $100,000. Then we have a $10,000 excess here, and that's going to go into paid in capital in excess of par value. Okay? So that's how you account for shares of stock, selling stock in for the corporation to raise money, raise equity. Okay, let's talk about treasury stock next. Okay, treasury stock. So Crystal Lake Corporation started a stock repurchase plan in the current year. Below are the related transactions. Record each transaction in the journal provided. So July 11th, the corporation reacquired 60,000 shares of its common stock at $40 per share. Well, treasury stock goes on the books at cost, what you paid for it, what they paid to reacquire it, in this case, $40 per share, and it comes off the books at cost. So we're going to put the treasury stock on the books. And as I mentioned before, treasury stock is a contra equity account. It's not an asset, even though it sounds like an asset. You're buying something, but it's not. It's a reduction in equity. You're taking those shares and putting them into the treasury. What might you do with these treasury shares? Well, you might reward your management with some stock options or stock grants. You might, if your stock is under pressure, sometimes corporations sometimes buys back their stock to create some demand for that stock, to support their stock in the open market. There's several reasons why corporations buy back their own stock. A byproduct of that, it helps with their earnings per share because it lowers the amount of shares outstanding. Earnings per share is calculated on the outstanding shares. So that's a kind of a byproduct of buying back your own stock. Okay, so here you have 60,000 shares at $40 a share, or $2.4 million, and cash is flying out the door. $2.4 million, you're buying back the stock. Okay, and you're putting it into the treasury. On September 12th, a few months later, we sold 30,000 of the reacquired shares for $43 per share. So we bought it at 40, we sold it for 43, we made $3 per share. but we don't record the gain on our own stock. We don't record gains and losses to our income statement when we buy and sell our own stock. What happens is just gonna adjust equity. We'll see what happens. So we sold the stock, so cash is coming in. How much cash came in? Well, we have 30,000 shares times $43 a share. So $1,290,000 came into the corporation. And what's coming off the books? The treasury stock is coming off the books. So we find treasury stock and the 30,000 shares at what we paid for it, $40 a share. So again, when on the books at $40, it's coming off the books at $40. The excess, the $90,000 excess over what we paid for it, again, it's not gain on sale of treasury stock. It's paid in capital, additional paid in capital, the treasury stock, paid in capital and treasury stock. Okay? Again, it's an equity account. It's under the paid in capital section of the stockholders' equity. October 2nd, we sold 20,000 shares at only $36 per share. So now it's below what we paid for. So we have a loss, if you will, but again, we don't record the loss. So let's show the cash coming in. We've got 20,000 shares at $36 a piece, so $720,000. And we have treasury stock coming off the books. I'm going to drop down a line. You'll see why, because I like to put the debits first, then the credits. So treasury stock is coming off the books at the 20,000 shares times $40 what we bought. Okay, so we have a shortfall, if you will, here, or a loss of $80,000. So where are we going to debit? We can't record loss on treasury stock sales. So where are we going to put this debit? Because our entry has to balance, right? We have 80 on the left and 800,000 on the left, 800,000 on the right. So if we have money in our paid in capital from treasury stock, we're going to take that money out of this account. We have 90,000 in there. We're going to take 80 of it out. So paid in capital and treasury account will be debited for the shortfall, if you will, on this sale. Okay, so we have money in there. If we didn't have money in there, we'd have to put it against retained earnings. Okay? So December 5th, we sold $10,000 of the 10,000 shares of the reacquired shares for $38 per share. Again, so cash coming in. So we get 10,000 shares at $38. So we get $380,000. Treasury stock is coming off the books. I'm going to drop down a few lines here. You'll see about why in a bit. Treasury stock is coming off the books, the 10,000 shares at $40, what we paid for it. So we have a $20,000 hit here, loss, if you will, that we have to account for. Well, how much do we have left in our paid in capital and treasury stock? We had 90 in there. We took 80 away. We only have 10 remaining in the account. So we can debit paid in capital and treasury account for the 10,000, what we have left in the account. So now we have 0 in the account, right? We started with 90, we took 80 away, we took 10 away again. So where are we going to put this other $10,000 debit? It's going to be hit against retained earnings. Retained earnings is going to be, it's going to come out of retained earnings. It's the only place it can come out of. Okay, so that's how you account for treasury stock. So we looked at issuing stock, and now we looked at treasury stock. We're going to look at a dividends problem, but before we do, I want to share this slideshow here on accounting for dividends. Let's take a look at it. Okay, accounting for cash dividends. How do we account for it? Well, there's 3 key dates with dividends. There's the declaration date. Okay, on the declaration date, the board of directors declare the dividend to the public. The XYZ Corporation declares a 25-cent dividend to all the shareholders of record as of October 2nd. And we paid out on October 29th. Okay, just picking random dates here. So declaration date. The date is when the board of directors declare dividends. That is when they're on the hook to pay for it, right? So then there's the date of record. The owners of the stock as of this date are entitled to receive a dividend. The ex-dividend date is typically the day before. If you don't have the dividend if you don't have bought the stock by the ex-dividend date, you are out of the money, if you will. You won't get the dividend. Okay. And then you have the date of payment. Okay. So 3 key dates. Date of declaration, you're gonna make a journal entry on date of declaration. Date of record, no journal entry, but it dictates who gets the dividend and who doesn't. And the payment date is when the actual dividends are paid, okay? Entries are required, again, for the date of declaration and the date of payment, but not for the date of record. So what does that look like? Let's assume that on December 15th, and December 15th, we have the board of directors declares a $29,000 dividend to be paid on January 4th, as detailed below. Okay. So preferred stock, there's a 4% preferred stock, and let me talk about that for a minute. 4%. 4% typically, preferred stock is either expressed as a percentage of par value or as a dollar amount per share. If it's expressed as a percentage, that's a percentage of par value. So if the par value of the preferred stock is 100,000, 4% of 100,000 is $4,000 dividend to preferred shareholders. They get the dividend first, and then what's left over, common shareholders, they get $50,000, 50,000 shares at 50 cents a piece, or 25,000. So the total dividend paid out is 29,000. What's the journal entry look like? On the date of declaration, the journal entry will look like this. You debit the dividends account, which is a contra equity account, and you credit dividends payable for 29,000. So on December 15th of 2020, the board of directors declared the dividends. We're going to be debiting the dividends account, and again, contra equity account. It eventually will be taken out of retained earnings eventually when we close the books at the end of the year, and then dividends payable goes on the books. All right. So then what happens next? Oh, as I mentioned before, the declaration of cash dividend is debited to a contra equity account called dividends, and it creates a current liability called dividends payable. Okay. So paying the dividends, the dividend pay date is January 4th. What happens? The payable comes off the books and cash goes flying out the door. Okay. So that's pretty simple, right? On the date of declaration, you put the liability on the books, and the date of payment, you pay off the liability. Okay. So let's calculate a preferred share. How do you calculate what the dividend is per share for preferred? Well, it's either stated as a percentage of par value or as a specified amount. So as an example, how much does one share of 3% preferred stock with a $50 par value receive when dividends are declared and paid? Well, 3% of $50 is $1.50 per share. That is what they would pay, $1.50 per share. Okay? That's what they would get paid. Right? So how much does one share of $4 preferred stock with a $50 par value receive when the dividends are declared and paid? Well, if it's expressed as $4 preferred, they're going to get $4 per share as their dividend. Okay. So also, there's basically two types of main types of preferred stock. There's cumulative and non-cumulative. Cumulative preferred stock is the most powerful preferred stock. That means that if you have if you bought a cumulative preferred stock, that means you get your dividends before any current dividends are paid if the dividends have been passed over. So let's say year one, year two, corporation's not making any money, they're not declaring dividends. Then the cumulative preferred shareholders, they don't miss they didn't get paid for the first 2 years. But if year three comes around and the corporation declares dividends, they have to go back and pay the year one and year two dividends that were passed over. That's the cumulative preferred shareholders, very powerful. Okay. Non-cumulative, if you miss the shares dividends for the year, you miss it. That's it. Right? So you just keep going. Okay. So cumulative and non-cumulative preferred stock. Cumulative preferred stock accumulates dividends each year until the dividends are paid. Dividends in arrears means dividends passed or not paid. Just a fancy word for dividends that have been passed over. Dividends in arrears. Okay. Sometimes it's a funny words, right? Dividends in arrears get paid before any current year dividends are paid out. Non-cumulative preferred dividends not paid do not accumulate from one year to the next, as I mentioned before. Okay, so we're going to assume that preferred stock is cumulative, if not specifically designated as non-cumulative. Okay, So let's look at an example. A company has 4,000 shares outstanding of 5%, $10 par value cumulative preferred stock. The company also has common shareholders. Let's calculate the preferred dividend per year. Okay, so that's the first thing you do. So you take the 5% of the $10 times 4,000 shares. So every year, in total, the preferred shareholders get $2,000 if dividends are declared. Up at least $2,000 the dividends are declared, the preferred shareholders will get their $2,000 in the aggregate, all the shareholders. So if the board of directors declare $15,000 of dividends for the year, the shareholders will see the following. The preferred shareholders get their $2,000 and the common shareholders get the rest, $13,000. Okay. Let's use the previous example, except now assume no dividends were declared for 2018 and 19, and the board of directors declare $15,000 in 2020. First, the dividends and arrears need to be paid. The 2018 dividends and arrears, again, this is for cumulative preferred shareholders. The 2018 dividends and arrears, $2,000 will get paid. Then the 2019 dividends and arrears for $2,000 will get paid. So $4,000 so far out of the 15. Then they have to satisfy the current year dividend, the 2020 dividend, for $2,000. So you see already $6,000 of dividends have already been paid out to the preferred shareholders for the current year. The past 2 years that were passed over in arrears, plus the current year, before the common shareholders get anything. Okay. So then the common shareholders gets what's left over. $9,000 is what they get. Okay. So what if the stock was non-cumulative? How would the 15,000 be divided? Preferred shareholders get 2,000, common get 13, non-cumulative preferred shareholders miss out on the prior year undeclared dividends. Okay. And that's it. Okay. So let's go back to the dividends here. We're going to look at this example and close out this video for corporations. Accounting for cash dividends. Mantle Corporation has the following stock outstanding: 50,000 shares of cumulative preferred, 5% stock with $20 par value, 500,000 shares of common stock with a $10 par value. This is what is outstanding. Okay. During the first 5 years of operations, the company paid the following cash dividends: year 1, 5,000, 30, 75, etc., years 1 through 5. Okay. So we know the history. So we want to see how were they paid out. Okay. So we're going to calculate the expected preferred annual dividend. How much? First of all, we'll calculate that first because we need to know what the cumulative preferred shareholders should be receiving every year. Okay. So what do? Let's do the math. We have 5%, 0.05 times $20 par value times 50,000 shares equals $50,000 a year. That's the annual dividend. Again, it's the 5% of $20 times 50,000 shares. Okay, $1 a share. Okay. All right. So we need that. So we determine the payouts for each year. So let's take a look at the first year. Year 1, $5,000 was paid out in dividends. Okay. Who gets the $5,000? Well, preferred shareholders always get preferential. They'll always get the dividends first. They're going to get the $5,000. How much is that per share? Well, we're going to take the $5,000 divided by the 50,000 shares outstanding. They're getting 10 cents a share. Okay. So common shareholders, they get nothing. There's nothing left over for them. So they get 0. Okay. So we look at the first year. Year 2 comes around. Board of directors. Well, let's put something over here called an arrears. So what do we have in arrears? Every year the common shareholders are expecting, cumulative shareholders are expecting $50,000. We'll only pay them 5, so we still owe them $45,000 from the year 1. Okay, let's keep a running total of what's in arrears. Okay, year 2. We have $30,000 declared by the board of directors. Okay, so there's one thing I need to mention about when the board of directors declare a dividend. There's things that need to take place. First of all, the corporation needs to be making money. They need to have positive retained earnings to pay out a dividend. Second of all, they have to have cash. Just because they're making money doesn't mean they have cash. They could be cash constrained. Okay, so they must have available cash. So one, they have to be making money, must have positive retained earnings. Two, they must have cash in the bank to be able to pay the shareholders. And three, the board of directors need to declare the dividend. Okay, so year two, $30,000. All that is going to go to preferred shareholders because we still owe them $45,000. So they're going to get $30,000 divided by 50,000 shares outstanding. They're getting 60 cents a share. Common shareholders get zero. What do we still have in arrears? Okay. Well, we know we had the 45,000 that was in arrears, right? And we know we have the current year dividend of 50,000, and we only paid out 30. So that means we still have $65,000 of dividends in arrears. 65,000. 15 from the prior year plus the 50,000 current year didn't get paid out. So we still owe the preferred shareholders $65,000 after year two. Year three comes around. Board of directors declares $75,000. Not bad. Getting there. Well, how much do the preferred shareholders get? Well, they get the $65,000 in arrears, plus the current year dividend of 50,000, but there isn't 50,000 to go around. There's only 10,000 more to go around, right? So they're going to get 75,000 divided by 50,000 shares. They get $1.50 a share. Common shareholders get zero. What's in arrears? Okay. Well, again, they had 65,000 plus the 50 currently minus what they paid out, 75,000. So they still owe 40,000 in arrears. Okay. Now we come to year four. Board of directors declare $125,000. What do the preferred shareholders get? Well, they get the dividends in arrears, the 40,000, plus they get the current year dividend of 50. So they get $90,000, right? Or 90,000 divided by 50,000 shares, they get $1.80 per share. Now the common shareholders get something. Ding, 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 ding. Yes, we get something. 125,000 minus the 90, they get $35,000. 35,000 divided by 500,000 shares outstanding, they get 7 cents a share. Not bad. Better than a sharp stick in the eye, as they say. What do we owe for dividends in arrears to the cumulative preferred shareholders? Zero. We're satisfied all the dividends in arrears, so we're up to date with that. Now year five comes around, $275,000 of declared dividends. Preferred shareholders, what do they get? Well, there's no dividends in arrears. All they get is their current year dividend of $50,000. Again, 50,000 divided by 50,000 shares, they get their $1 per share that they're expecting. With common shareholders have a bonanza. Finally, they have a good sized dividend, 275,000 minus the 50,000 paid to the preferred shareholders. They get 225,000 available for them, which would amount to 225,000 divided by 500,000 shares, or 45 cents per share. So over the life of this 5-year span here, all right, we've got $510,000 of dividends paid out, of which the preferred shareholders got 250,000 of that, and the common shareholders got 260,000. Okay. If you look at the $250,000 over 5 years, that's 50,000. Average is $50,000 a year. Okay, it just took a while to get there, right? But they're all caught up with their dividends and arrears. Nothing left, right? And preferred shareholders, they finally get some pay dirt. They get some money. Okay. So now let's just record the journal entries for year 4. Okay. What would it look like if let's just say May 14th was the declaration date, the date of record was May 28th, and the date of payment was June 8th? What would the entries look like? So on May 14th, we're going to debit the dividends account, which is a contra equity account. For year 4 was 125,000. And then we have dividends payable. You could split this up into dividends payable on preferred and dividends payable on common, but I just put it all into one, keep it simple, dividends payable. Okay. On May 28th, there's no entry. It's the date of record, no entry. So we're not, there we go, no entry. Okay. On June 8th, the date of payment, what happens? The payable comes off the books, 125,000, and cash goes flying out the door. 125,000. Okay, so that's how you account for cash dividends. There are stock dividends as well, and there's our stock splits and what have you that are beyond the scope of this video. But okay, so I hope you learned something about corporations and how they account for stock transactions and dividends and treasury stock. I'll see you next time. Accounting is fun.